Mike Zlotnik, also known as Big Mike, and he is the host of the Big Mike Fund podcast. A fund manager, mainly investing into real estate, doing some private credit things, but really wanted to have Mike on because I was intrigued with just his diversity within real estate and diversity within investing. We speak about a great deal of things, mainly trends within real estate, what we think is going to happen into 2026. What do we think that an AI bubble and that popping would do to real estate? We talk about the trends within real estate of the wealth transfer. We speak about the sexy or unsexy nature of owning real estate as the American dream and where that's going. Again, very wide-ranging conversation. Hopefully it helps. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Mike, welcome to Rethink Real Estate.
Thank you, Ben, for having me.
I'm excited. You have your own podcast. And that we were just discussing before. And at the end of the day, you've got a wealth of knowledge in your area of expertise. And that's what I wanted to give you a chance to go through at the beginning of this episode so that people understand who we're talking to, so to speak. So give us an understanding of background, where you've come from. Obviously, they can tell we've got two people with accents here as well. And then also, what you're doing now.
Yeah, so let me start. James Bond had a famous movie, From Russia with Love. I don't come from Russia, I come from Moldova, Republic of the former Soviet Union. I left in 1989 when it was still Soviet Union. So I come from Moldova with love. Okay. And I came to the US in 89. I'm a US educated. I studied mathematics and computer science, and I spent 15 years in technology career. But I started investing in real estate passively in New York City in 2000. That was my first investment, talking about expensive market. So I started residential real estate, just buying apartments passively. And then I continued my technology career. In 2009, I was ready to switch. I had a great career, but my passion has always been real estate. Right. So I switched to real estate fund management full-time 2009, continued to invest in real estate. And that's been my journey since 2009 until now. It's been residential real estate as well as commercial real estate for many years.
Excellent.
That's the short version. And just a couple of words about me, right? I am married to my lovely wife, who is from Ukraine on the border of Moldova. Again, geography lesson. Now you know where it is because the Russia invaded Ukraine. So you got to look on the west side of Ukraine. That's where Moldova is.
Okay.
And we live in Brooklyn, New York. We have 4 monkeys and a cat. 4 human monkeys. We have 4 kids and actually a cat.
Well, I'm glad that you referred to them appropriately because, at the end of the day, they can be monkeys at certain ages. There's no doubt about it. But
mine a little older, but I still call them monkeys from time to time.
There you go. That's good. Well, Mike, it's an absolute pleasure to have you on the podcast with the wealth of experience. Can I? I'm going to segue into a topic that we didn't discuss before the podcast. I'm interested because I have a property in New York. I love New York City. It's in Manhattan. It's in the West Village. We are based in Newport Beach, and Callistra and I love to go to New York. Obviously, we do a bit of business there as well through our real estate business. But I'm interested to hear your take. First and foremost, I have a feeling that, again, as a property owner within Manhattan, I don't know that it's the greatest real estate investment from a residential perspective. If you were to look at different marketplaces, capital growth, and all of those different things, I'd love to get your take on that. Second question, or second part of the question that I'd like to get your take on, because this is relevant to the time that we're recording, is that there's obviously a bit of a change going on for the mayor or some competition going on for the mayor of New York. And I'd love to get your take on, I'm going to get his name wrong. Is it Mondami or is it Mondami? That people are very fearful of him getting in from the socialist perspective. And I'd love to get your take on what you think it'll do if that is the case and him getting in, which seems to be a foregone conclusion to many people. I don't know the details of it, but considering that you're there and you understand real estate as well as what you do, I'd love to get your take on both of those aspects.
Sure. Let me start. So I started investing in real estate in New York City, and I still own a bunch of apartments. And my observation is no cash flow. It's all appreciation play, but appreciation comes in waves. So in general, New York has continued to appreciate over time, but there are waves and there are political environments where appreciation can stall. If Mandani gets into office, and most likely he will, and he'll try to implement a little too much of socialistic practices. I grew up in the Soviet Union. I saw what socialism was. It bred a lot of corruption, a lot of inefficiency, a lot of bad behavior. Um, some countries, Canada, Australia, there's a form of socialism, right? But it's a more of a not American version, a capitalistic version of socialism.
Yep.
So socialism by itself, the word is not necessarily terrible, but some implementations of that could be pretty bad. We'll see what happens. We've had other very liberal mayors. Before that, we had de Blasio, whose wife stole $1 billion. My guess is a lot of these folks want to be very popular, so they run on a very popular campaign. They get in an office, and then ultimately they want to enrich themselves. So we'll see what happens, where it goes from here. Certainly, it can have a negative impact on the city, but there's plenty of significant folks with a lot of capital here, and they'll continue to, they'll try to control him to whatever degree, so he can do the giveaways and please his constituents at the same time. Don't do things that are really going to hurt some of the fundamental reasons why people are in New York. That's the first. Well, it's both the first and the second, right? So when you invest in New York versus investing in Midwest or somewhere else, here I've owned apartments for a long time here, and I've seen appreciation. That's the only play here. The cash flow is essentially non-existent or very, very little if you buy for cash. If you have leverage, no cash flow. So people invest here for different reasons. They invest because they want to touch something. It's a location, and you expect long-term appreciation. While if you go some of the other cash flowing markets, appreciation is a lot more subdued, but you have more cash flow. So it's a matter of a choice. People can diversify and own property in like New York and LA, and then they can also invest for cash flow in Midwest or wherever they feel comfortable.
Yeah, no, well, that's a good rounded element. And again, I want to get broader with our conversation. I just wanted to sort of hit on just one more point within the New York marketplace itself, because it feels like, I spend a decent amount of time there. It really feels like the city's alive at the moment in many ways. It's certainly lower Manhattan, there's no doubt about that. And, like in the energy that there is in the West Village, Tribeca, all of those places, it feels great. You've got JP Morgan Chase that has just opened up their headquarters and spent billions upon billions upon billions of dollars bringing people back into Manhattan to say that you're coming back to work. You've got other massive investments that have happened there. It just feels like the wind is being taken out of the sails, so to speak, from a lot of people that are local in that perspective, just based on the possibility of what Mondami will bring. So anyway, like you said, we will see. There's no doubt about that. But as far as the real estate marketplace, from your perspective, being a fund manager and ultimately looking at this from a very broad perspective, I find myself, our business, we operate, we did auctions last year in about 30 different states in the US. We have a non-distressed luxury auction business. We get to see a very broad perspective of the market. We have real estate offices really predominantly on the West Coast in California and Oregon. And the thing that I'm seeing at the moment is this spotty nature of the real estate marketplace across the country. If you say Florida, Tennessee, Texas, Arizona, Colorado, these marketplaces, I'm not going to say free fall, but they definitely are in double-digit decline from, what properties were listed at versus what they are selling at if people are selling. Inventory levels are up. But then you go to the Northeast, then you go to the Pacific Northwest, and still very resilient marketplaces, primarily probably based on price point, because they are two of the lower price point areas in the country. Southern California, though, you look at that, and even with the massive number of people that are retreating out of the marketplace and going into more affordable areas, still a very, very resilient marketplace over that $2 million perspective. It just seems like it is an incredibly hard pattern to pick, and I'd love to get your take on sort of what I just gave you as a synopsis.
Sure. So we actually have a project we invested in Manhattan, block away from Central Park, redevelopment of a 20-door apartment building into a single-family residential townhome that's going to sell, hopefully $65-70 million sales price. That market is doing incredibly well.
Yep.
It's the Wall Street, right? Think about this. The stock market has been performing really well. lots of wealth and people can afford high-end residential real estate and they're paying still top prices.
Yep.
This would be true for New York City. This would be true for Southern California and many other markets where the high-end residential seems to be doing well because of the wealth effect of the stock market and similar. On the other side, if you're talking about a more affordable housing where people are very sensitive to affordability payments, there's a lot more sensitivity. And then also supply demand forces, right? The markets you mentioned, Sunbelt region, there's been negative rent growth. So if you look at the data, this actually came across my desk about a few days ago.
Yep.
We saw multiple Sunbelt market, Phoenix, Austin, parts of Florida, negative 3 to 4% rent growth. Essentially, the rents are falling versus Northeast, opposite, 3 to 4% positive. Again, that's the kind of the supply demand forces based on what's been built and where the supply demand. But from a migration pattern, if you look at the people are migrating, they're moving away from New York City, some to Texas, some to Florida. If you look at California, people moving into some one-way tickets to Austin, Texas, and etc. Nonetheless, the markets still get overbuilt, and the pendulum swings too much either left or right. So what I would say on the residential front, it's all local. It's really all local supply demand and how the investment is happening in a given town or city, job creation, etc. So one more variable I'm going to throw in, and we could talk for hours.
Yeah.
But it's AI impact, right? AI is a huge uncertainty whether it's going to create jobs or eliminate jobs, where the investment is taking place. So residential markets and where people are going to be able to work and live will depend on kind of impact of AI. New York City is pretty vibrant right now. Again, It's the Wall Street effect. When the Wall Street does well and the stocks are up, New York City is generally pretty
very
happy.
financial market driven, isn't it? Yeah. Whereas
Still.
you look at San Francisco from that perspective, is that's a marketplace that we've been in very heavily for call it 6 or 7 years now. And before AI, that was an area that I wouldn't have put my money in. There's no doubt about it. But AI has kind of saved the Bay Area, if you ask me, from a capitalization perspective and giving something back to Silicon Valley, so to speak. And that it's funny how those industry shifts can change all of that. And certainly from the perspective of that, AI as well, I still think that we're in this stage at the moment where, the technically, if we look at this, is that we look at the largest technology revolutions, arguably over the last, call it century, was the aeroplane and were cars. It's probably longer than a century for cars. But both of those industries, if you own GM Motors or you own, an airline, they're horrible industries from a financial perspective. They're not valued very high, but ultimately the ancillary industries that are around those are the ones that make the most amount of money. So whether AI turns into air travel or whatever it may be, and that industry becomes that, it's still obviously subject to see. But where I'm going with all of this is that, as you said, that it still has a massive impact. I want to bring it back to the fact that I do believe that we're in some type of bubble at this point. No one knows how big the bubble will be in AI. No one will know. No one knows when it will pop, and if it does pop, how big the pop will be. Like the .com or like 1929 or whatever it looks like. If you look at Andrew Ross Sorkin's new book and everything along those lines, he talks about the comparisons of now. What happens to real estate if that bubble does pop? Is it like what? I don't remember the .com pop. Okay, so you might have a bit more insight to that. Like, what happens in the real estate investment space or market if it does pop?
Yeah, it's a great question. I'll just try to get to the forward crystal ball projections on real estate with a full disclaimer that it's a crystal ball conversation. I used to have a wonderful crystal ball. It broke. I can't find another one for sale. So all this is speculative.
Yeah.
But yeah, it does remind me, Ray Dalio and then number of other folks have talked about this is very close to what 1999 looked like. I certainly remember that. I was in the technology world and there was a massive reset, and it's a super AI. It's a super race right now, US versus China. It's also a race to whatever you call it, super intelligence, without really clarity how these investments will pay off.
Yep.
So that's a huge danger zone. the dot-com boom, companies were just literally getting insane valuations based on number of users, and ultimately they couldn't turn a profit. They burned through the cash, and the market crashed. So I certainly have very serious concerns about the bubble conditions, and I feel this. Again, this is a personal opinion. There's a reversion to the mean. Sooner or later, the market will correct. So it feels like we are overdue. Who knows what happens? When it happens, it's going to be wealth effect, negative wealth effect. So you're going to have some level of correction, how people feel about their investments and what they will do with their capital. On the other side, if the correction starts happening, maybe the capital will flow into real estate way more because of the deep value opportunities we see today.
Yep.
Again, it depends on parts of real estate. Real estate is a broad term. We operate quite a bit in commercial real estate, and we see very significant opportunities because the interest rates are higher and the cap rates are higher. As a result, the prices are lower. And when you can buy into these assets today, and when the market corrects and the Fed has to cut faster and there are more job losses, we might see tailwind. Real estate gets significant tailwind from lower level of interest rates. Now, it's still supply demand of properties, especially in the residential side. So every market is local. But I generally expect if the bubble pops and then there is layoffs and uncertainty and we go into some slowdown, potential recession, that'll actually be positive news for real estate because the rates get cut faster than the job losses impact demand.
Yeah.
So,
and Mike, that leads me to the next question, although, because I really wanted to get your take on this. There's a transfer of wealth that's going to happen over the next, again, whether it's, some people say 10, I'm listening to different stuff. Some people say 10, some people say 15, some people say 20, some people say 25 years, that the boomers are going to be handing over who have most of the wealth in the country and hold most of the assets will be handing over that wealth as they die off, so to speak. And they're saying that is a really bad thing for real estate because the younger generation that is going to be holding most of that, whatever $90 trillion transfer of wealth or whatever they call it, is they're going to probably sell a majority of that asset, and that will be really bad for real estate because most of it is held in real estate because the younger generation tends to be moving more into the liquidity markets of crypto and stocks and all of those different things. Do you buy into that? Do you see that as a challenge for real estate as we move forward? Do you see it as an opportunity? I'd love to get your take.
It's a great question. Interestingly enough, this transfer of wealth discussion, I haven't thought that deeply about it, whether you're trying to solve a multi-year problem with generational wealth transfer in the form of real estate. And we're living in a different age with kind of the old sages, all wise men, the Charlie Mungers, the Warren Buffetts of the world, the Ray Dalios. Some of them will look at them as dinosaurs, and they've embraced the world of crypto and rapid growth and liquidity. I think the pendulum swings both ways. You may see some level of adjustments, but at the same time, real estate is still real estate. And what's interesting is some of the younger cats who have made it in crypto, some of them come to the conclusion that they actually need to diversify too. So the changing world patterns and maybe some level of younger generations, people also live longer, right? So this wealth transfer could be a very long-term type of exercise, and fathers and sons and these type of books are old, and these discussions come around. So it's a cyclical process. It's not a binary process. Suddenly, everybody wants to move away from owning real estate. It's still an American dream. People still want to own a home. And from investment perspective, sooner or later, people do consider alternative investments. The reason people go into real estate is because they have a lot in stocks, they have a lot in crypto, and they need to have some tax efficiency. They need to have other benefits of real estate, the benefits of leverage, the benefits of cash flow. You can't find a yield. Take S&P 500. The yield on S&P 500 is 1.2%, as an example, right? And you want a yield of 6, 7, 8%. How do you do that? Well, you go into industrial real estate, absolute triple net, as an example, right? You can get a good, strong yield from the beginning, and you can get a predictable growth. It may not be as exciting, but some people not all about excitement. They actually prefer to build a portfolio that gives them lifestyle quality. So I don't have a categoric binary, all of a sudden all the wealth is going to be concentrated in the hands of young very fast, and suddenly they're going to change the pattern how they invest. I don't
Yep.
think that's going to happen overnight. And people don't, COVID was a big risk. If a whole bunch of old people die off, all that wisdom, but COVID is past, right?
Yep.
So obviously we lost some of the loved ones, but at the same time, there's plenty of people, and with the advancement in AI and medicine technologies, life expectancy continues to grow. So folks in their 40s and 50s and into 60s expected to still hold significant wealth over many years to come.
Well, Mike, I want to segue into, obviously you've got a broad array of different things that we could speak about here, but I want to talk about Big Mike Fund podcast. That's a podcast that you host. How often do episodes come out on that? Is it weekly?
Once a week.
Okay. And what are the topics that you sort of run through, and what is the insights that you're giving on your podcast?
It's broad range, right? So my primary business is investing, right? Commercial real estate. We also do some residential. We do both private credit lending, and we also do equity investments. So what I do on a podcast, I bring industry experts, could be an open air shopping specialist or industrial specialist, or folks who are borrowers, or folks who we invest with on a credit side, or could be a completely separate. I've had people who will talk on a Fed policy, right? They just where the Fed is going, and are they going to cut rates faster or slower? So it depends. It's a broad range. I don't do volume of these episodes. It's just more of a discussions, and then some guests will talk about. Some people love turnkey properties, right? Residential real estate, and they want to invest in turnkeys. Wonderful. So we'll talk about turnkeys. Very flexible. People will talk build to rent communities.
Yep.
So it's very fluid. It's not a mission just to talk about one thing. If we find a good guest and they come on a podcast, we'll talk about their business kind of. So it's a little bit of everything. Some episodes may be interesting. Some may be, I don't want to hear about this. This doesn't interest me. So it's just kind of like I just go with the flow, and I just want to have a good conversation, and hopefully it's a little bit of entertainment and educational.
The private lending space. You brought that up just then. That some of the things that you do. It's funny. I looked at the Blackstone put out their synopsis for their investment strategy for 2026, and part of that was the private lending market, private credit market. It seems to be a marketplace that definitely is trending in the upward direction. Obviously you've got the conventional lending, and then you've got hard money lending, and it needed this middle ground, and that's sort of arisen over the last little while to be more popular. It's probably always existed to an extent, but it's become more popular where, the regulations in order to get a conventional loan. Like I had a friend who moved recently. He's got $2.5 million in the bank, is in a fund, but yet he couldn't get a loan for $1 million home just based on a few different things that had happened over a period of time, where I'd lend him the money based on who he is, what he has, everything along those lines. It just made it very obvious to me how difficult it is to jump through those hoops at the moment. What do you look at? What do you see the upside in the private credit space is over the next little while? Do you see it getting to being a pretty large industry?
Well, it's already a large industry. It's actually a very large industry, and the private credit stepped in where the banks stepped out. So as liquidity froze, as Fed hiked fast and furious and kept higher for longer, you essentially saw significant liquidity dry spell, a really fast drought, and the banks just stopped lending and lending less and less and less. So the private credit stepped in. It's yesterday's news. Of course, they're still talking about it for 2026. It'll probably still be a fairly robust year because the banks are still very, very tight. And the reason the banks are tight because the real estate deals, especially the banks that land in real estate, are stuck. The volume is low. They're not getting repaid on their loans, both commercial and residential, so you don't have fresh money to lend, in a manner of speaking. So private credit continues to be a good alternative. We do private credit. To me, hard money lending is private credit, right? So the rates have been healthy, and the deal flow has obviously been there. At the same time, as Fed starts to cut, I feel the attractiveness of that strategy will be less and less.
Yep.
because of the effects of the lower level of interest rates.
Yep.
So there's a direct and indirect correlation. As Fed cuts, overall the returns in that sector will continue to come down.
Yep.
Now, what I do see is that it is still a good strategy for foreseeable future. But there are better ways to deploy capital. One of the ways I compare, just going to give you one comparison, and I've talked about this recently, is how do you compare what is on the same level of risk as private credit,
Yep.
but it is a lot more attractive in my view, and it's triple net industrial. Why? Because you could get actually the returns that are in the, let's call it 15-16% IRR range, and you can get yield in the 6 to 8%. You can get tax benefits. You can get depreciation, bonus depreciation. You can get safety of very long-term leases with
Yep.
predictable rent growth, right? So it's still equity, but you are getting returns and a risk profile very similar to credit, and your returns are meaningfully better than a credit. So
Right.
as a way to play yield, you could play yield and get in private credit, let's call it 9 to 11% returns, but it's all current income, interest income. If you're investing with cash and you're taxed on that money, you have nothing to write it off against other than interest expense.
Fair enough.
So if you're investing self-directed IRA money, interest is perfectly happy for self-directed IRA, right? But for cash, it's not as interesting and as attractive because of high. You're in California, I'm in New York. It's taxed brutally. If you go into something else, you could get comparable after-tax effect on the yield, and you can also get better upside. So I don't have anything negative about private credit. It just has to be looked at with the right type of capital, tax efficiency, and obviously careful selection of what do you invest in. Is it single asset loan, or is it a portfolio? Is it a fund? And what the portfolio looks like. So there's a lot of what I would call underwriting when you're writing a check into private credit.
Right. Well, I think that there's another part in all of this as well that I want to get your take on is that in the residential marketplace we were speaking about this before, is that it's the American dream in order to own a home, right? That dream seems to be in the younger generation of things at the moment, based on what we're looking at and what we're doing in many different ways through the residential marketplaces. The younger generation of people are tossing up the factor of, well, why would I? And obviously, this is interest rate driven. There's no doubt about that. And lower the interest rates, the more activity that there's going to always be in real estate. But it sort of seems that it's stemming to the fact that most people are saying, well, hang on a second, if I measure this up against what I would pay for rent and what I'm putting into a mortgage, the other things that we need to consider are the property taxes, the utilities, and everything along those lines that add up to being the X amount of payment. I'm paying, say, $5,000, $6,000, $7,000, $8,000, $9,000 a month for a property in my payment, which includes all of that. But it probably maybe only $1,000 or $500 or whatever it is, depending on the interest rate, is going to towards principal, and they just don't feel like it's something that is money put to good use. They might as well spend less and go rent a property and maybe put that other equity into the marketplace. It just seems to be that there is this, and maybe it's because rates have been higher for longer. That this has started to come out, whether it be through social media, whether it be in the forums that we are doing, whether it be just in the buyers that we are talking to, doing the volume of transactions that we do as a company. It just seems to be in the articulation once they look at the payment that they're just figuring out that maybe this isn't a good use of my money.
Yeah, a couple of comments. A lot of great nuggets there. It's exactly the right way to think about it. But I think what's really important is also element of the family formation. So younger folks, and my oldest daughter is married, and and she's already family formed. So if she had an opportunity to buy a house, I think she would.
Yep.
She's still studying to be a veterinary doctor. But the moment she's going to get a job, she might rent initially, but at some point, people want to have their neck of the woods, their own property, whether it's an apartment in the city or a house. The bottom line is, yes, affordability is a huge factor. Rent versus own, the math is the math, right? And you could look when the interest rates are high, affordability of ownership is basically ownership is more expensive than the rental. But it depends where around the country. New York City, it's always been way cheaper to rent than to own relative to the payments.
Yep.
California, probably the same way. So I would say this way. depending on family formation, decision to actually settle down, have your own place, can play a big role in the decision. It's not all purely math. We could rent an apartment for $4,000 a month, or we could, own the same apartment. It's going to cost us $7,000 a month, all other things being equal. But we're building equity. It feels like our place, right? So some of this effect is psychological. Yes, affordability, math. I'm a mathematician. Yeah, you make mathematical decisions until you start making emotional decisions. So I would say all that is correct. Affordability, and it feels like as rates come down, affordability will really pick up and home ownership will become attractive again. And you may have a shift from kind of renter's mentality to some more home ownership. But then it's a question: it's going to be supply demand. Do we have enough product?
Yep.
So all these forces continue to influence where we go from here. So I don't have an exact answer other than
No. That's fine. And again, I think the podcast has been very wide ranging, and it just goes to show the depth of your knowledge in things. Mike, I guess that what's the way that you run your fund? Is it something that people can come and invest in, and people can give you capital to put to work? Is that how it works at this point?
Yeah, people could reach out, right? So today we run funds, but we also run one-off partnerships or syndications. And recently, we've seen very significant shift. Most investors actually prefer one-off deal syndication.
Yep.
And why they do this is because funds not easy to underwrite. You got to look at the fund portfolio. You got to look at a lot of complexities looking in funds and understanding what you're investing into. With one-off deal, especially new, it's way easier to look. For example, we just invested in open air shopping in San Diego, Southern California, headquarters at Seaport. It's an open air shopping downtown San Diego, right?
Yes.
You can actually understand the property. You could see where it is. You could look who are the tenants. You can look at the leases. You can look at a lot of factors. So, people can reach out and they can look at the projects we have available today and what we're working on next. We don't do volume. We do a few good deals per year.
Yep.
So if people reach out, they want to get on our email list. We appreciate the opportunity. We'll send them the deals when they become available. And we still do funds,
Yep.
but I'm just observing, especially recently, much more folks are interested to see. You're in California, I'm in New York. There's people that reach out and they are never going to buy anything in California or New York. They
Yes.
tell me, I don't want to write a check in a Socialist Republic of New York or Socialist Republic of California. Again,
Yep.
back to we started the episode that way. We understand that, we'll respect that. So for those folks, maybe they invest in an industrial deal in Indiana.
Yep.
So there's a lot of different ways to look at it. And people, when they write the check in the fund, do you have anything in California in the fund? Yes, we do. I'm not doing California. I'm not doing a fund because you got some in California. Okay, no problem.
Yep.
So it's kind of interesting how people look at things. It's a matter of opinion, and tastes different. That's the best way to put it.
Well, Mike, we appreciate the wide-ranging conversation that we've had today. We'll make sure all of your information, including a link to your podcast as well. I think it'll be great for people to be able to join that podcast and get some depth into some other fields that they can speak intelligently about real estate in general, not just residential, and understand all of that parts of it. So again, thank you for joining us, and looking forward to the future and what it holds for you. Indeed, it seems like you've got your finger on the pulse.
Yeah, Ben, I appreciate your wisdom, and I'll just make this offer, right? So people can go bigmikefund.com. This is the podcast, and it's an entry point. And if they misspell it, they get to bigmikefund.com. I promise it's not a kinky site. But I'm working on a new book. I already have one. I'm working on a second book. It's coming out hopefully soon, and people can actually sign up and get a free copy. So that's my offer.
What's the first book? What's the first book called?
Oh, it was about top 10 questions you should ask before investing into a fund or syndication. It's right. It's almost to the point where, who is the manager? What are the fees? What do you invest in? It's just all these questions to understand a fund. For whatever it's worth, it's too technical. Some people have actually appreciated it, but the new book is going to be a little bit more of so I'm a chess master. I'm also an investor, and I've been doing a series of videos, kind of investing in the eyes of the chess master. So it's going to be my observations and some of the lessons from Charlie Munger, Warren Buffett, Ben Graham, Ray Dalio, Howard Marks. And it's all correlated to kind of thinking a little bit of it like a chess master. How do you make all these analytical decisions? But at the same time, you got to know yourself and make the decisions that are right for you and your goals.
Well, Mike, at the end, looking forward to that coming out. And thank you so much again for being on Rethink Real Estate.
Ben, thank you for having me.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.